Tom Lee was just on CNBC talking about the current market situation and why it's pulling back. We're going to listen to what Tom Lee has to say, and I'm going to explain and break down everything that he said and why you should not worry about the stock market right now. Don't worry about subscribing, smashing the like button, or looking for the coaching and Discord link. We'll get to that in just a little bit. But first, before we listen to Tom Lee, I am hosting my free webinar this coming Friday, January 17th, 8 p.m. Eastern Time, 5 p.m. Pacific. Every single webinar I have ever hosted, every student that attends say they learn more in the 1 hour they spend with me than anywhere else. Link to join is in the information box below. Spots are very limited. A lot of students couldn't get into the last webinar because we filled up. So use that link to get yourself registered right away. I'll have a huge announcement during the webinar, and I'll be answering a Q&A. I hope to see you guys there. Let's take a listen to what Tom Lee has to say.
The 10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in Fundstrat Head of Research and Fundstrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is, it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times, so I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So the second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from NVIDIA comes out yesterday, makes comments saying that, some of the supercomputers are still, and the full realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias, thinking, look, we've neared a top, or that stocks are just awful now. I think we're getting close to the point where, you should be betting really and leaning heavily against that. I mean, even look at AI sentiment. it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
So you heard what Tom Lee had to say. He talked about a lot of different things, and it's pretty much what I've been trying to explain to you guys, that the market right now is in a 3-week recency bias. It's overreacted to what's actually happening. A recency bias is the tendency to overemphasize the importance of recent experiences or the latest information we possess when estimating future events. Recency bias often misleads us to believe that a recent event can give us an indication of how the future will unfold. This is a problem because we have taken what's going on in the last couple of weeks to month, and we have come up with our own bias of what we think is actually transpiring when it's in reality not. And that's basically what Tom Lee is saying. And we have to also look at something else Tom Lee said that was very important, and I don't know if you guys really caught it when he said it, but it's the most important thing he said when he explained that small cap stocks are basically performing the worst they've had in over 100 years, with the exception of 1998 to 2000. With that exception, they're not performing well at all. Right now, small caps are trading at a median PE of 11 times, whereas the average is usually around 20 to 25. And Tom Lee said this earlier, meaning small caps should be performing at least twice as good, if not more, than they are right now. And the same goes for mid caps. That's part of the reason why SoFi, way back when, in April, May of this year, wasn't performing too well. Although it's more of a mid cap stock, it was really being hammered, and a lot of other stocks were as well. This is something to really think about. Also, small caps currently are 7 times cheaper than the S&P, and usually they're closer to 15 or 20. So again, it just shows you there's a 2 to 3x gap here on the small to mid cap, and this is due to a lot of factors. Recency bias has just emphasized it even more negatively than normal. And the recent ISM readings are also good for small caps, mid caps, and mergers, acquisitions, and overall for business. This is not where the 10-year yield is going to be, Tom Lee said, in the coming months. It's going to come down. When the job market is softer than expected, that puts the Fed put back in focus. Feds can start cutting rates again. Right now, they can't do that because the job market isn't soft enough landing as they expected. It doesn't mean we're not getting rate cuts in 2025. It just means they're not happening as soon, like January or February is unlikely. We could still get them, but they're looking unlikely. Not to mention we have a couple of hawkish members that are replacing dovish members with the FOMC, so there's also that. Then there's the Donald Trump situation that is kind of stirring things up with the tariffs. We don't know how Donald Trump's going to handle tariffs. If he smacks tariffs on a bunch of different companies, including Canada and China and others, it's going to also create a little bit of distress in the stock market as well as the economy. Could push inflation up. I don't think he's going to do that, but the market does not like uncertainty. So as soon as there's some uncertainties in the market, people will start pulling their cash. Investors, big institutions, they put it on the sidelines, and there's $7 trillion sitting in money markets on the sidelines. Another thing that's really hurting the market is the fact that people are selling off and getting out of quantum stocks due to what Jensen, the CEO of NVIDIA, had said about quantum being at least 15 to 20 years away and that it's way too early to invest. Created a lot of sell-off on those stocks as well. Before we get to what Tom Lee said about the AI stocks, we talk about the AI sector. If all of this is confusing you and you're really looking to learn in the stock market, or maybe you've been trading, not doing so well and you're losing, or maybe you just want to retire early, I would love to help you, fam, achieve your financial goals and dreams. I achieved mine, and I told myself when I did so, I would do my best to help others, and I created a system that works. I have students that went from 8,000 to 40,000 in just 5 months, other students from 30,000 to 100,000 in the same time frame. You can see the comments on the screen. And like I said before, I'm a Catholic. My parents are very hard on me to do the right thing and help others, and that's why I do this, because I love helping others and teaching them how to achieve their financial goals and make their life better, just like you. I really enjoy doing this. It is my passion. And if you don't believe me, let's take a listen to my students Josh and Adam had to say.
For anyone who's thinking about joining, is anyone can do this. It's just really like putting in the work and the effort to meet Corey halfway, but he will definitely get you there. I started with about $300,000 portfolio. Initially saw about between 60 and 70,000 within my first 6 weeks, which I was very excited about. So now I'm really, really excited to share that I've grown that $300,000 portfolio to well over 500,000. I'm definitely reaping the rewards now. Don't wait. I honestly can't thank Corey enough.
So I started with 15,000, right? I am now at $40,000. Okay. And I'm so proud. It feels, amazing to be able to share this, because I know that there's so many people that will do the same, right? You have to just trust Corey and trust what he's teaching and what he's offering, because he means so well.
So you heard my students, Josh and Adam, had to say, if you would like to sign up for my Discord training course and one-on-one coaching, so this way I can help you grow your portfolio and teach you how to become more profitable and get you on a consistent winning basis, you guys got to go to investorcorey.com. Links in the information box below. Click on training. Once you get to the website, you can watch the video. It'll explain everything to you, and then you can book a call with my team and I so that I can help you achieve your financial goals. And I look forward to seeing you very soon. Tom Lee explained how investors and the general public messed up with AI. They didn't take it serious until it boomed. Same with the social media, same with the internet 20 years ago. History repeats itself. And right now, people are actually in fear of quantum and AI. Tom Lee was explaining that the AI sentiment was almost back to a negative, which says a lot. That's the reason why Netflix is having a rough time. So is Tesla, Nvidia, AMD, Taiwan Semiconductor, SMCI, ASML. All these companies are struggling right now. The AI sector is not good. It's not doing well right now. And that's the reason why Nvidia has been consolidating left to right, or barcoding, so to speak, since May. It's been 7 months. Nvidia has done nothing. And like I said, there's only so much market share one company can acquire, but I'm even more bullish on AMD. But right now is not the time. And I've explained another thing that Tom Lee didn't even mention, which is tax loss harvesting. You got to understand, when you tax loss harvest in December, or like near the end of December, you can't buy those stocks back for 31 days, or you get hit with a wash sale. If you sell, let's say, Coca-Cola for a loss on December 30th, and then you buy Coca-Cola back on January 29th, you can't use that as capital loss. It's now a wash sale, meaning if you add $20,000 worth of capital gains and you lost $5,000 on Coke, you really only had $15,000 worth of capital gains. 20,000 minus 5,000, 15,000. However, if you buy it back after the new year and it hasn't been a full 31 days, well, then you get hit with a wash sale, meaning you can't claim that as capital loss. You're back to $20,000 capital gain, even though you bought the stock in 2025, you sold it in 2024. It's a wash sale, meaning you got to pay tax on the earnings in 2024, for 2024 in 2025. That's the example. It's a wash sale. So right now, there's not a lot of buying going on in the market. That is the whole premise behind that explanation. So we also have that in addition to everything else Tom Lee talked about. We have that on top, that there's not even really any buying going on. That's why if you notice, SPY is not going up very much. It goes up like $1 or $2 and then drops the same $1 or $2 right back or more. Very few stocks are making any movements. Now, wash sales don't affect other stocks. You could sell Coca-Cola for a capital loss and then go get into Pepsi, and that's totally fine. But you have to understand, a lot of investors were taking losses on different stocks, getting into different stocks. But there were some stocks, especially in AI tech, that were really heavily in the red with some investors, and SoundHound being one of them, because you have to understand, near the end of December, SoundHound started pulling back. And when that happened, a lot of people were in the red. So they were selling and they can't buy it back in January, which caused the price to start going down. And then more people started selling it and shorting it. And then the shorts get back in and it creates a lot of short selling pressure. And this has happened across multiple stocks. It's also the reason why you'll see people sell out of Marathon and then immediately MicroStrategy runs, because you can take the loss on Marathon and go get into MicroStrategy or Coinbase, because they're both crypto stocks, technically speaking, and that gives you exposure to crypto. But you can't buy Marathon back because you sold it for a loss in December as part of your tax loss harvesting. So everything that Tom Lee said in this video, in addition to everything I'm saying, and then on top of that, Donald Trump and the tariffs and the issues he's had with court battles and the witch hunting going after him, all this stuff is just a lot of chaos. Then you also have the issues abroad. with China, Taiwan, Ukraine, Russia. Then you have the issue with Lebanon and Israel and Iran, all the political, geopolitical tensions around the world, all this wrapped up. This is not a good time. And historically, January is not even a good month anyway. So this is definitely not a good month to be trying to sell and make profits. But what it is a good month to do is to do what I teach in my Discord, what I teach my students to do, which is what we're doing right now. My students made thousands of dollars last week because we bought stocks on the bottom. When they moved, we made money. We also sold covered calls. The stock market was going down. We were just printing free money. And I teach my students to do this and how to do it, when to do it. This is the key. Right now, you want to be dollar cost averaging. You see in red, you're dollar cost averaging, buying stocks, buying leap option. And then when the stock drops again, you're dollar cost averaging your shares and your leap options. And then once it stabilizes and in February, things start moving back up, maybe Donald Trump doesn't do any tariffs, things look better, the sentiment's better, the 10-year yield will settle down and things will get better, then you're going to be in the green and all kinds of profits with these stocks. Look at the 10-year yield. Right now, we can see it right here. And it was the same height, roughly, just a little bit lower in this past April. But the stock market was doing fairly well in April, although we ran up so much in here in August. It kind of tanked a bit here in August. It was right around here while the 10-year yield was dropping. The market tanked. It doesn't like the 10-year dropping below the 2, and it definitely doesn't like the 10 flying up. There's got to be some form of stability or neutral to the 10-year yield. If it's too high, too low, it doesn't work out well for the stock market, but typically the lower it goes, the higher the stock market goes, but a recession or inflation is kind of imminent. When it goes higher, it's more stable for the economy, but the stock market goes down. So having the 10-year yield somewhere in the 4.4 or 4.2 range is ideal, maybe 4.5, but 4.7 is getting up there. When we look at this 10-year yield, you can clearly see that right around here, the stock market tanked and it was really bad. Then it got a little better. And then right in here, it started to run and then it skyrocketed right in here. It was still going up, but it started to stabilize. Then it starts going down and things get out of control. The sweet spot is somewhere here in the 4.2, 4.3 range. Things will settle down. It doesn't stay up this high for long. It usually only lasts about 3 weeks to a month, as you guys can see based on this time frame. And then it starts to drop. Last January, it was climbing. And then in February, it came back down. Then it started to climb again. And then in April, it was at really high amount, like 4.7 almost where it is now, not quite. And then it kind of pulled back. And this is a requirement for the feds to cut interest rates. We're going to need to see the 10-year yield come back down. It's going to have to come back down to this level, like pre-Christmas levels is where we're going to need to see the 10-year. So right now is not a time to be fearful. It's a time to be greedy, slowly but surely, dollar cost average. Wait it out in January. If you must, keep some of your cash in a cash position for your SPACs or FDIC insured cash sweep. And things will get better as we get into February and into March. Things will get a lot better. And when the next rate cut happens, we go through earnings season, the end of January, February, March. If companies are reporting good earnings, that's also going to help boost things up. So inauguration, PMI data, jobs data, as well as earnings season, all coming up in the next 30 to 60 days are going to make a big difference in the stock market. Don't forget, if you guys want to sign up for my training course, Discord, and my one-on-one coaching so that I can help you grow, link is in the information box below. Don't forget my free webinar this Friday, January 17th, 8 p.m. Eastern, 5 p.m. Pacific. I look forward to seeing you there. Limited spots remain. Link is also in the information box below. I will catch all of you on the next video. Take care of yourselves.